Hello and welcome viewers. I'm Hiral Dadia in conversation with Sunil Subramaniam, MD at Sundaram Asset Management. Sunil, what volatile times that we are seeing in the equity markets, not only in India, but it's across the globe. I think no one knows what direction are we going in with the kind of impact that we are seeing on the back of COVID. What are your first thoughts onto it?
Well, the first thought is that this is unlike any other crisis previously experienced by the economy or the stock markets. I mean, you take the 1918 Spanish flu, or you take the World War, or the Great Depression of 1929. Probably these are somewhat similar because the global financial crisis was especially limited to the area of finance, and it also limited to the developed world to some extent. But this one, it's not just the finance world, it's much more wider. And the second is that it's not limited to the developed world. I think it's across all countries, developing and poor. So naturally the impact and the expected impact on the markets are both highly, in an uncertain state at this point in time.
Right. So what is the sense that you're picking up? Where do you actually place India right now if you have to compare India to the other economies?
So I would break out this whole crisis in three parts. So the first is the medical part of the crisis. The second is the economic impact of the crisis. And the third is the markets impact, the stock market impact of the crisis. So if you were to look at from a medical perspective, right, I think if you've been tracking the news and everything, I think that India's response has been phenomenal. I think the government has been probably one of the best governments in the world in terms of the speed of action, the intensity of action, and the timing of the action. I think all of them, if you listen to Mr. Modi's speech yesterday also, that was made very clear. So I think medically speaking, especially given the fact that we are a developing country, especially in health infrastructure. And if this were to spread rapidly here, it would be catastrophic because of the lack of adequate medical infrastructure. So in that context, the way we have managed it, I think has been very good. And I would actually rank our country very much high on the scale of response to the medical aspect of the crisis. Coming to the economic aspect of the crisis, there are two aspects. I know the government has done a lot in terms of giving away rations, giving money to Jan Dhan Yojana, women, people, giving away money to the farmers and setting that right. But perhaps in terms of the fiscal stimulus as a response to the medical crisis, the government has probably not done as much as other advanced countries have done. Now, if you look at the logic of that, there are two things there. One is that the medical crisis itself is much more advanced in other countries. That is number one. Number two is that the resources of our country are limited compared to that. Our fiscal deficit is already at a high, 3.5% of fiscal deficit before this started. There was a growth slowdown in progress already. So given the fact that the growth slowdown means the revenues to the government would be slowing down, and the fact that disinvestment which the government was expecting to do to manage the fiscal would now looks like a distant possibility given the markets where they are, I think the room for the government to do a massive fiscal has been limited, and they have not been able to pump money directly into the economy to the extent that many developed countries have done. So there, I would say is that probably the government's thought process is to wait for the medical thing to be in control before they loosen the purse strings on the specific sectors of the economy. So I think it's just a matter of time. I think if you wait this month out, it will be fairly clear as to the level of impact, and the government hopefully will announce far more fiscal steps. So I will believe that, and I would draw your attention to the fact of the IMF. Ms. Gopinath, who's the chief of the IMF economics department, he said that India's growth rate for the current year is going to be down to 1.9, and a few other analysts, in fact, have taken it to 0.
Correct.
But the interesting point I'd like to point out is that very same document, they say for the year 2021, after the 2021, the 2022, India will be back to 7.4% GDP growth.
Yeah,
so mind-boggling growth.
On this, I'm going to interfere over here, Sunil, because clearly overall, if you go to see right now, the kind of impact that we are seeing now, events like the US-China trade war, US presidential elections, Brexit, the great slowdown of the Indian economy, all of these will actually appear like a footnote in history relative to what we're seeing in COVID. But very interestingly, I was reading a couple of reports which are clearly indicating that India's decline in real activity already started in July 2019, and this is as per the Brookings FT Tiger Index that was released in April 2020. And taking that into consideration, if you take the consensus forecast for India as well across institutions, everyone's expecting the GDP growth at around 3% on an average. Now, taking all of this into consideration vis-a-vis what the other countries are expected to see in terms of GDP, don't you think we will be better placed and probably emerge as a new superpower?
Well, I think you're on the right track. And let me just clarify to why I agree with you there. So the first thing is that if you look at it, our slowdown was of self-made problems. It was triggered by demonetization. It was triggered by the GST, being a game-changing reform, and its implementation issues. It was triggered by the fact that good monsoons meant inflation turned negative in rural India, and hence demand got affected. None of these was related to the world. So the point I'm trying to stress here is that all these events will have an impact for some time, and after that, India would slowly but surely have come out of it. One. Point number two, we are, of all the major countries in the world, the one which is least dependent on exports. We have about 25% of our GDP coming from exports. So to the extent that a slowdown in the world, right, that means when you say 25% is exports, 75% is domestic. So to the extent of the domestic economy, we are not so affected by the recession of the world. That's number two. Point number three is the COVID crisis has actually led to a sharp correction in oil prices. Prices of oil. Fourth is that even other commodities and metals which go into manufacturing various items, the metals also, with the US and other countries being in a slowdown recession, metal prices also will be soft, which for an import heavy country like India is again a favorable thing. And finally, the biggest strength of India is the people, the number of young people in the world. So what is happening because of COVID, as you're hearing already the noise and the news around how China has managed the crisis, is that the world's dependence on China is going to gradually come down, and they are going to look at an alternative country into which they would start their sourcing. And India, with its land mass, we are the seventh largest country in the world, with its population and with the English language skills, we are ideally positioned to substitute China over the next decade. So I would fully agree with you in that India this is a golden opportunity once the medical part of this crisis is handled, right, from an economics, right, over the next decade for us to become the next big superpower in the world.
Right. And very interestingly, you pointed out the demographic dividend as well, because in 2019, India has already entered the 37-year period of demographic advantage. So that's something that could be working in our favor. Apart from that, yes, we could actually take the supply chain disruptions as an opportunity to supplement China, because I'm sure we will not be able to beat China at this current point in time, but we will be able to at least supplement them. Spendings is something we could be looking at as well. But with all of these growth engines of India that we have been talking about right now, Sunil, where do you see problems first? Which are the sectors, where there could be issues right now, taking the demand as well as the supply side into consideration?
So I think the two big things which are going to be impacted are the what I would call it as the discretionary consumption area. There is a basic consumption of goods and there's a discretionary consumption. When I say discretionary consumption, it's a very wide ambit. So you would get consumer durables, you would get high-end automobiles in that. You would get air travel in that.
Correct.
You would get media and entertainment. Because in this crisis, what's happened is that a lot of disruption has occurred in the economy, and naturally incomes are going to be in the short term under pressure. So people would, when the medical crisis gets over also, they will take time to come back to the high-end expenditure to rebuild their confidence around it, right? So people would hunker down immediately after a crisis. They would probably save a little bit more, keep their money in cash handy to handle it. So it's a natural human reaction. So I would say that for the next part of this year, because let's assume this medical crisis gets over by end of June, right? And then let's say that for the next 6 months, right, till December, you would say that the economy will slowly limp back to normalcy, because once people get deeply impacted, right, they would take time to come back and spend on what is a discretionary, what is a basic necessity, they will obviously go and spend. So I would say that's where you would see that there would be a bit of time for the economy to recover from these kind of sectors that I already mentioned, right? The second aspect is that given the fact that the lower end of the population has been migrant population and the casual labor has been impacted, the kind of borrowings they've done could lead to the fact that those people who are exposing themselves to that aspect of the economy could face a challenge, though government has allowed the 3-month moratorium and all that. Mind you, they're not waiving the interest. So the interest clock keeps ticking. So naturally, there'll have to be some degree of forgiveness of those loans, some degree of the lower end to protect the bottom of the pyramid, right? So I would say those NBFCs which are lending into that end of the high risk end of the market, they would probably see a spike in their NPS. So that could be a big correction in terms of their EPSs and all of that. But those which are at a good quality NBFC, I don't think the problem. So that's the second aspect of it should get affected by this, negatively affected.
Right. Sunil, but as you mentioned that good quality NBFCs will not be affected. I know I don't want to talk stock specific, but even if you see the likes of the Bajaj twins and all, we are seeing a lot of impact. Now, one reason that I'm picking up over here is also with regards to where restructuring of the NBFC loans is concerned. That's something apparently reports are suggesting is something which will not be allowed. And probably it's the NBFCs that are already pricing in this. Now, if you have to take this into consideration, do you see an impact coming in on businesses across, even for the good quality NBFCs then?
Good quality NBFC can take on its own a decision to restructure the loans. Right? It doesn't matter whether RBI gives them the permission to do that. They can themselves say that, okay, we need more money and shall reschedule it. It's in the power of NBFCs to decide what it does with this loan book, right? And I think the good quality NBFCs do have the capital. There is no shortage of funding for them. In fact, even the long-term TRO that the RBI has announced is specifically to help these sectors of the economy. So I think the good quality NBFCs will survive and in fact come out stronger from the current crisis.
Right. And overall, especially from the healthcare perspective, another question I want to take is, in fact, I was just talking to Dr. Velumani of Thyrocare as well, and he's actually indicating right now that in spite of this being a pandemic, it's the healthcare sector which has been impacted the most, because majority of the hospitals, majority of the diagnostic labs, everywhere, there is only allowance for COVID testing. Any chronic diseases, any patients with cancer, people who have to go for dialysis, all of that has been on a standstill. Now, at this current juncture, probably everyone would have assumed that it's healthcare which is going to be flourishing as a sector, which not really everyone wants, at least on the practical front. But what's the sense that you pick up then? Do you think this should be a sector that should be avoided then?
No. See, I think what Dr. Velumani mentioned is the healthcare provision to the people is suffering if you're not a COVID-related patient, right? But you look at the healthcare industry itself, right? Whatever they are doing, the India is actually the golden opportunity for India to become the pharmaceutical capital of the world. Already, if you're seeing for hydrochloroquine, right, it's India that the world is dependent on. And I think the quality of India's pharmacy graduates and biochemists and all of that means that this is a great opportunity for India to take the leadership on the healthcare side for the world. And I would say that it's a short-term impact of the COVID crisis that hospitals have been earmarked for COVID. And I think in the larger interest of the nation, it's a small sacrifice for the healthcare community to do. But I don't see this as lasting, like I said, beyond June 30th. But the manufacturing of medicines, now every country is going to now seek to stockpile medicines, create an adequate cushion of medication. And I think India has a wonderful opportunity here to actually, if you see, even in the early stage of the COVID crisis, there was a worry that a lot of APIs being manufactured in China and that supply was getting disrupted to India. So now going forward, if you look at it, maybe that means that India now starts making those APIs themselves. Maybe it's an opportunity in substituting China for our own needs of API which we were importing from China. So I see the future for the healthcare industry as very bright, leaving around this current quarter where the resources have been diverted to tackle a specific emergency. I think in the longer term growth of the healthcare and for India's ability, and I think Mr. Modi also said this very clearly, that we have to take care of the world. We can't look at narrowly only at our country. If anywhere in the world they need medication, India should stand at the forefront. And I think that the pharmaceutical industries will see very good days ahead.
Right. So Sunil, overall, if you have to talk about recovery from here on, whenever it starts, may it be June, July, August, September, if you have to see the recovery curve, what are the sectors which will be at the forefront of the recovery? What investors should actually look at as well?
See, for the rest of this year, like you take this quarter out, and then the rest of this year, as the economy is limped back to normalcy, there is enough abundant liquidity in the markets. So the immediate response of all market participants to study will be to seek the safety sectors, which is your FMCG, your pharma and healthcare, like I said. So I would say that for the rest of this year, it's going to be a largely safety-oriented driven kind of a story, right? Early part of next year, because by 2021, I think the economic recovery signs will be clearly visible. Then if you then look at it, right, the sectors which will then grow, actually I mentioned discretionary consumption as something negative for this period, but I would say when things then come back to normal, that pent-up demand will come through in the next year. So discretionary consumption, leave apart the next 6 months, from 2021 onwards, I would see discretionary consumption picking up, because as people forget this COVID crisis and forget it, and economies come back to normal, their earnings come back to normal, they will start spending on their desirables, as a discretion. So I would say the premiumization of the economy would be the first thing that would happen. That's number one. Number two would be that I expect the governments, which are currently focusing on monetary stimulus, right, giving away money, to move into a fiscal stimulus, which is rebuilding the nation and generating employment and factories and all of that. So when that fiscal stimulus kicks in, which I think will happen next year, because this year the fiscal room is limited because the money has to go towards attacking the immediate pain points. But next year, the focus will come back on infrastructure and rebuilding the nation. And you will see that core building materials, cement, goods, steel, all of these will start, because employment generation is the key. And one of the triggers for this would be the fact next year will be the year when you will also see shift of the China manufacturing to India get kick-started. And just well before the COVID crisis, the government had already relaxed the taxation to 17% for a new unit being set up in India, which is equal to the best tax rates in the world. Subsequently, they've removed the dividend distribution tax also, which is making it even more attractive for a foreigner, for a foreign entity to come and set up. So FDI will start flowing in, and I would expect the manufacturing sector to be the real big story of 2020.
Right. So, Sunil, my last question coming to you, especially on the mutual fund data, which is just out last week. It's a very interesting fact that we've seen, because the inflows that have come into the equity mutual funds have already surged in the month of March. And this is at the highest level even in the year, in spite of the broader markets actually witnessing heavy volatility on the back of the impact of coronavirus. What's the sense that you're picking up on the mutual fund industry? Is it that investors now actually want to place their bets with someone who really knows how to read the markets instead of taking their own bets?
No, it's also more fundamental. I think what's happened is that parallel in this crisis, banks have been cutting rates tremendously. Today, SBI on a savings bank is giving 2.75%. So people are seeing that their money, while they want to keep it in safety, it's actually eroding in value. That's number one. Number two is that if you take the SIP culture, which has come in, means that now people are realizing that any correction means that they are adding more value to their future. So I think there's a fundamental thing here, and the industry has spent big bucks in terms of advertising. This mutual fund sahi hai, SIP sahi hai, or most lately they have put on MS Dhoni and Sachin Tendulkar to
Correct.
also promote mutual funds. So I think the general awareness of mutual funds and the fact that in SIPs when the market corrects you benefit, somewhere that message seems to have trickled through, aided by the fact that the competing bank deposits are coming down in interest rates. And what has also helped is the fact that you've had big banks also in trouble in this period. You have NBF is in trouble. So I think the fact that there is risk everywhere, and if you're taking risk in the equity market, at least you get the reward when things turn. I think this message which is slowly coming through into the middle class and the upper middle class. And that's what is seeing that there is a resilience that even in a market correction, people are not panicking and pulling out their money from the equities as a space. So I think that's good. And I think you talk about people directly buying stocks. See, that in any case was not a big thing. The big shift has occurred from bank deposits into mutual funds. I don't think it is so much about people who are putting in stocks now putting in mutual funds. So the people who put in stocks are basically those who either they have retired and are sitting with some corpus and want to play around, or they are speculators, or who like the charm and the acceleration of stock market investing. But the primary increase in mutual fund penetration has occurred from the fixed deposit industry directly into the mutual fund industry. And I think that's where I would like to thank, even Nirmal Bang and distributors like these who have given the right message to the customer that equities are a long-term vehicle that you put through SIP means all the midterm corrections that happen actually add much more value to the wealth you will create in the long term. And I think that's played a very big role in the resilience of the investors in this particular point in time in the market.
Right. So mainly, Sunil, lastly, the fund is actually flowing into the equity side of business, whereas you are seeing, withdrawals mainly from the liquid or money market category.
No, see, I think that was a specific 1 month issue because March end normally there's an outflow. So
Correct.
I would wait for April data to make that judgment. Where money has been consistently flowing out is in credit risk funds.
Okay.
Because ever since the credit crisis of ILFS started and lots of mutual funds started to do, you have seen every month on the credit risk category has lost risk. I didn't realize that credit risk means I lose money. They were earlier probably not risk meant that you could actually lose capital. And now realizing that if you're going to then take that risk, then equities is probably better because I may lose capital 1 month, but next month's market price would recover that capital. Whereas in credit, something falls, it's gone until you go through a legal process to recover the money.
Correct. Correct.
I think that's the thing that has happened from debt to equity. This is that credit risk category.
Right. And lastly, your view and your recommendations to the people who are already invested in the markets and to the new investors who would like to come to the markets. What would your opinion and view be?
Primary vehicle for an equity investor to put money in, right? Simply because of the rupee cost averaging principle. That's number one. So whether it's an existing SIP, okay, even if it's a 12-month SIP, because over the next 12 months, you're going to see a lot of volatility, but at the end of it, it's going to be a recovery story for the world economy. And say start an SIP if you're a lump sum investor. If you're an existing SIP investor, or sorry, if you're a new investor, very good time to start an SIP. But if you're an existing SIP investor, I would to add to it, because when rupee cost averaging story we are saying, if you believe the story, put more money into the markets, they're done. So a person who's already put a 10-year SIP, use the next 6 months to whatever spare cash you have, go and double your SIP installment for the next 6 months, next 12 months. That means you're actually enhancing the true wealth creating capacity of the SIP by being smart. So I would say, make your SIPs a smart SIP by actually putting in more money over the next few months.
Right. So it's going to be a motto of save, invest, and prosper that the investors actually need to look at as well at this current point in time. Thank you, Sunil. Thank you for joining us on the show and giving us this great advice as well. And for the investors, we will come back to you once again once we see some bit of data coming in for the month of April as well to analyze what the mutual funds are indicating. Thank you for joining in.